Over half of Americans do not invest in any way in the stock market. This is according to CNBC. But this shouldn't be surprising because they also said that more than 1 in 5 of us don't trust the professionals, the advisors and the brokers who are responsible for advising us to make these decisions. So when we start talking about the stock market and interest rates, it gets a little confusing. Even Chris Katowski from the Oppenheimer Company says anything but straightforward when talking about the stock market. So let's first talk about the vocabulary involved in the interest rates and stock markets. I mean, what does it all mean anyhow? Then we're going to talk about how the system works together, but we're going to go through that real quickly, and then we're going to talk about how we can make this information work for us. So when we talk about the economy, we talk about good or bad economy, and that's straightforward, and we all understand that. But when we talk about recession or an overheated economy or a weak economy or a bear market, sometimes that gets real confusing because it's not straightforward. And then you've got the good side of things, which is just as murky. And you've got an expansionary economy, you've got a buoyant economy, you've got a strong economy or a bull market. I mean, who would think that a bull market is a good thing? So the first definition that we're going to talk about is interest rates. And when we talk about the broad definition, we're talking about the Oxford definition. And essentially what they're telling us is that it's the cost to borrow money. Then we're going to look at the more specific definition related to interest rates and stock markets, and that's the definition of the discount rate offered by the Fed. But what is the Fed? The Fed is the central bank, and their purpose as intended is to control inflation and moderate the economy to obtain full employment. That's the goal. But what is inflation? Inflation is related to supply and demand. And essentially it means that you get less bang for your buck. So it's a bad thing when inflation goes up because your money's worth less. But when we start to talk about stocks can be a little confusing too. We all know that it's ownership in companies. But how do stock prices even happen? So you own a house, and your neighbor's house down the street sells for more money than your house was worth. So essentially, the value of your house goes up. But if everybody on your street puts their house up for sale at the same time, nobody's house is worth as much. And the same thing applies to ginormous companies like GE with billions of stockholders. Even if a small fraction of their stockholders were to all try to sell at the same time, it would put the stock price down. But what actually determines stock prices? Because we know that we buy stock to earn money off of the growth of the company. And that happens in 2 ways. Either the stock price goes up or that company pays dividends. But the value of the company is actually determined from this really crazy process called discounted cash flow. And essentially, you're estimating the future potential revenue of the company. So when the interest rate goes up, the present value that's estimated of the company actually goes down. So Sam Stovall, the American Association of Individual Investors, said, what do you really want to monitor? Interest rates. The reason that we're going to watch interest rates is because that's the tool that the Fed uses. They increase the interest rate to slow down inflation. They decrease the interest rate to grow the economy and jobs. But what does this have to do with the rest of this stuff, right? It's an indirect effect. Basically, by the national bank raising the rate that they offer money to other banks, those banks then raise the rate that they offer money to the rest of us, whether it be businesses or people. And when it comes to people, the money that they offer us, costing us more, means we buy less. Same happens with the businesses. So Larry Swede of CBS Money Watch said that the conventional thinking about the impact of interest rates on stocks is wrong. And that's because many factors impact the stock prices, not just interest rates set by the Feds. And it's more about what the stock or the interest rate prices are doing or not doing. Not so much whether they're going up or down, but why they're changing. So more importantly, you need to watch the GDP, because the GDP is going to tell you whether the country is actually growing the economy or not. So when we look at the changes that the Fed makes in interest rates, you're not going to see an immediate impact on the stock prices. Typically, that takes 6 to 12 months to happen. And so the rate that goes up is going to make you watch companies that have high debt, because it's going to start costing them more to carry that debt. You also want to look, when the rates are about to go up, at international diversification, including emerging and frontier markets, because they tend to perform better than the market when the rates are going up. The safest bet when the rates are going up, though, are treasury bills, short-term CDs, and bonds. But the key thing is that you need to know the companies that you're investing in. If you don't know the companies you're investing in, you don't know what their debt-to-asset ratio is. You don't know whether they are going to perform well when the economy gets tighter and things get slower. The important things that we learned today include the vocabulary, how the system works, and how to make that system work for us. So when we talk about this next quote by Chief Economist Dr. Lynn Reiser, when she says that the strategy of the Fed in gradually raising interest rates can continue as long as the economy doesn't soften materially at quarter point increments. Now we know what to expect. Before we started this conversation, we had no idea what we could do to be able to take advantage of those changes, or how those changes would impact us. And ultimately, if you're invested in banks and you know that the Fed's about to do a bunch of incremental raises, you know that there are certain banks that are actually going to perform incredibly well. So now, instead of being confused, you know what you want to do. You want to make sure that you remember that the key information starts in knowing the meanings behind what you're working with. You're going to look at the system and you're going to figure out how to make it work for you. But ultimately, the only thing that we can do is follow our gut feeling, because none of us can predict the future.
You gonna invest my money now?
I can kind of predict the future.